We are already in the worst housing market crash of a generation, and now the crash is about to get worse, much worse. We mean even worse than the 2008 crash. But what's causing the crash? And to keep your financials unaffected? Hey there! Welcome back to Finance Insights. Watch the video till the end, as we have an important tip to keep your financials stable in this crisis at the end of the video. So let's get started. When we take a look at the combined value of the U.S. housing market and the stock market, we see that they're valued at over $80 trillion right now. This is absolutely insane, because the size of the U.S. economy, the GDP of America, is only $25 trillion. So literally asset prices are 3 times higher than the size of our economy, indicating that we have another 30%, 40%, maybe even 50% to go in this market crash. And the problem right now for stock owners and homeowners, and those who have a lot of assets, is that as the Fed increases interest rates, that is going to incrementally degrade the value of their asset. Because the important thing to understand about all the values you see across the U.S. economy today, you got to understand that those valuations were all based on artificially low interest rates. An artificially low interest rate environment that lasted for the last 20 to 25 years. As you can see on this graph, interest rates have just continually been going down over the last 3 to 4 decades. We're basically close to zero for much of the pandemic, and that's what created the asset price bubble. As you can see on this graph, they're inversely related. The more that interest rates went down, the more that asset prices went up. But now that interest rates are starting to go up, we're seeing the asset prices go down. The metric that is a stat called the asset price to GDP ratio. You can see today we're at 320%, 80 trillion in value in the housing and stock market, compared to 25 trillion GDP. And the way you're going to know that it's time to buy is when this asset price to GDP ratio gets closer to the yellow dotted line, 200% of GDP. That is a more normal level. Historically, that's been the average for the last 50 years. To get to that average, we would need to see a 40% combined correction in both the housing and the stock market. Now the question is, how could this crash be worse than 2008? 2008 was so bad. How could 2022 and 2023 be worse? When we look back at this asset price to GDP graph, we can see 320% today is lower than what it was 6 months ago, when it was 380%, but it's still above the peak of the 2007 bubble. It's still above the peak of the 2000 bubble. That is why we are still in the biggest asset bubble of all time. And this is ultimately why we think this crash is going to be worse than 2008. Home prices and stock prices, they have a long way to go down still to get to a level that is more fundamentally supported by the size of our economy. Fed rate hikes are causing the initial decline in asset prices. This is just the start. After these Fed rate hikes is a recession. That's about to get a lot worse. There's going to be job losses, there's going to be unemployment, and they're going to cause consumption and demand in the economy to go down further, which is of course going to lower asset prices back down to a more. They can be seen globally. Great Britain almost had its own. The new British government announced tax cuts that were going to increase the debt by $50 billion. That caused interest rates in Britain to go up, and the Bank of England had to step in and say we're going to buy bonds as a last resort to support the market. Canada too is in the biggest housing bubble ever. And what's even worse is that some economists are proclaiming that the Canadian housing bubble has burst. Housing markets have indeed slowed considerably since their peak in February and March. But unfortunately, economic bubbles are notoriously hard to identify and are often observed only after they burst. With the expected downturn in the United States and the global economy, it's not difficult to see why Canada's upcoming recession could be worse than expected. Another big warning sign is what is going on in the energy sector. With prices of oil and gas, now oil prices are starting to shoot up because OPEC just announced that they're going to cut production by 2 million barrels a day. So that's likely going to cause your gas prices to increase significantly over the next month or two, which is a big problem for the US economy. Because potentially the one positive in all of the things that have happened over the last couple months was that gas prices went down. Well, now if gas prices go up, just as the Federal Reserve is aggressively hiking interest rates, well, that's going to be curtains on the US economy. The US consumer is already running out of money or has run out of money. The statistics we're seeing on things like credit card debt, on the personal savings rate in America, are suggesting that there is not much left in the tank for the average American to spend to support this economy. The people are having financial difficulty. They are having financial problems. They're not going to be able to afford discretionary spending. They're not going to be able to afford to go to a restaurant. Americans aren't going to be able to afford to go to a ball game. And yes, of course, they are not going to buy a house, and it's going to cause the prices to go down. Now, this is essentially what OPEC is doing right now. They want to cut supply to boost prices. Well, okay, good for you. But people around the world don't have money to pay higher prices. As a result, people are going to drive less. They're going to consume less, and the worldwide economy is going to crash, which is going to create a deflationary episode that actually in the long run is going to cause interest rates and mortgage rates to go back down. If you want to know more about the OPEC and US oil war, watch our previous video by clicking on the iCard here. And finally, everyone, we want to leave you all with some actionable advice in this video. What can you do with the information we presented on the asset bubble? Where is the economy is going? How can you make better decisions with your money and with your career? Our number one suggestion is to stockpile cash. Cash has been one of the best performing assets actually. Despite inflation, cash has done much better than the stock market, much better than crypto. It's done better than silver. It's done better than gold. By the end of the year, it's going to be doing better than housing too. So holding cash is so key, because it's going to give you the opportunity to pounce on these declines. And perhaps even more importantly, cash gives you flexibility in your life, in your career. Because we have very uncertain times ahead. There's going to be lots of layoffs, there's going to be lots of bankruptcies. We don't say that to scare anyone. We say that because it will be the reality. We're already starting to see it. And if you are someone who potentially gets laid off into the future, or maybe struggles at your job, or maybe your wages get cut, or your hours get cut, or maybe this downturn reorients what you want to do in your life, you're going to want to have cash on hand to pay your bills, to give you the flexibility to shift and change your career as needed. This is something we feel very strongly about. Now, lastly, we would love your feedback in the comments section below. If you are someone who is starting to see signs of the recession in your city, in your neighborhood, in your state, in your country, can you comment below and let us know what you're seeing? Also, if you want to know more about the oil war that the OPEC and BRICS are plummeting, please watch our recent video. It's on your screen right now. Thanks for watching. Goodbye.